Hey.
Magnificent.
Hey.
Magnificent.
Hey.
Magnificent.
Hey.
Magnificent.
Hey.
Magnificent.
Hey.
Magnificent.
Hey. We learned in the last episode how tech and ECNs replaced the specialist. The digital revolution grew stronger by the late 1980s as the stock market kept growing beyond what humans could control. One of the first places human limits became visible in this new era wasn't on the New York Stock Exchange floor, it was on Nasdaq. The National Association of Securities Dealers Automated Quotations, better known as Nasdaq, was created in 1971 by regulators as a transparent quotation system to keep prices fair for traders buying and selling stocks that weren't listed in the New York Stock Exchange. The prices were collected from market makers and displayed on computer screens for all to see, but you still had to call the market maker to negotiate the trade and hope that the price that you saw on the screen was still available by the time someone answered. There was no automation. The market makers were firms using their own capital to continuously quote buy and sell prices of the unlisted securities. They earned money from the buy and sell price spread. One of the most successful Nasdaq market makers operating inside that phone-based dealer-controlled system was Bernie Madoff, which should tell you something about how easily discretion could be turned into profit. On October 19th, 1987, the stock market fell more than 20% in a single day. On the New York Stock Exchange, trading slowed and prices became chaotic, but the system continued to function. Nasdaq experienced something different. Nasdaq didn't operate through a centralized auction floor. It relied on those market makers who were supposed to answer their phones and honor quotes. But during the crash, many of them stopped answering altogether. Prices were still visible on screens, but investors learned they couldn't trade it if the market makers refused to participate. Regulators stepped in to give investors confidence that this could never happen again with the Small Order Execution System, also known as the SOES. The SOES introduced a simple but important change. If a market maker displayed a price on Nasdaq, the system could automatically execute small orders against that price without requiring a phone call or dealer approval. Market makers still updated quotes manually and screens updated instantly, but if a stock started to move and a dealer's quote lagged behind the market, SOES would still execute against that stale price. Traders who were watching closely could take advantage of that delay. This approach became known as SOES banditry, but it also wasn't risk-free. When prices moved in the wrong direction, those same traders could be filled just as quickly at unfavorable prices. But the lesson was clear. For the first time, reaction time alone could determine who captured profits and who absorbed losses. Market makers adapted quickly. Once they realized they could be forced to trade at prices that no longer reflected current conditions, many became more cautious. So they widened spreads, updated quotes less aggressively, and prices started to reflect defensive positioning rather than pure supply and demand. And of course, some of these market makers abused these precautions. In the early 1990s, journalists started noticing a strange pattern in Nasdaq trading. It was rare for stocks to trade in odd eighths, and they clustered consistently in even fractions. What they uncovered was a quiet form of coordination. Market makers were avoiding stepping ahead of each other on price, preserving wider spreads, and reducing their exposure to systems like SOES. This practice became known as the Nasdaq odd eighth scandal. When it was exposed, market makers paid hundreds of millions of dollars in fines, and confidence in the fairness of the system eroded again. US stocks had traded in fractions of dollars for centuries. It was an inherited system from an era where prices were quoted in pieces of 8, and in 2001 the structure was removed when the US markets converted to decimal pricing, allowing stocks to trade in 1-cent increments. The impact was immediate. The spreads market makers were abusing collapsed and price competition intensified. Providing liquidity was no longer about experience or judgment. It was about updating prices faster than everyone else. And that's when automation became necessary. As electronic trading expanded, prices started appearing across dozens of exchanges at once. In 2005, regulators responded with Regulation NMS. At its core was a simple principle. Investors should receive the best price available anywhere in the country. To enforce this, exchanges were electronically linked and a national best bid and offer was calculated in real time. And for the first time, the market operated with a single national reference point. That meant the New York Stock Exchange could no longer rely on the floor to attract orders. It became one exchange among many, competing electronically for each trade. And now you're seeing the modern market take place. Trading centers went from rooms warehouse filled with people to computers designed to receive orders, compare prices, and determine executions in fractions of a second. A market managed by algorithms designed to quote, cancel, hedge, and adjust continuously with trading rules translated into code, and it all executed autonomously. But if the machines now run the market, who controls them? Like, subscribe, follow at The Magnificent on Instagram and X, and let's keep the education going every Sunday at 11 a.m. Central.